Hi everyone, today we're going to look at a co-working flex feasibility study for a 1500 square meter space across a floor, right? I did one for a 2000 square meter space and I went into a little bit of different detail. Like I took a different approach by focusing on where you should put it in the building, market dynamics and all that kind of stuff. So I'll put a link to that video in the description, but this one, I really want to focus on how to get your revenue assumptions right. So we're talking desk densities, meeting room theory, and then I've even got a mock P&L, which I can walk you through, like cost considerations, even management agreement structure and that. And if you're really interested in learning more, because I'm going to go relatively high level, because if I do everything in a video, it'll be like an hour and a half long video. Please reach out to me. I've got a link in the description where you can reach out to me directly for a consult. And, more than happy to build your model, do all that kind of stuff. We can have a chat. So we've got a 1500 square meter space. Let's talk desk density first. And why 1500? I personally think, and I've delivered, close to 15 of these things across Australasia now, where we design, build, and operate co-working spaces on behalf of landlord clients, which means I don't have my own brand and I'm trying to build a portfolio. In my role, if there's a commercial property owner, office owner that realizes co-working or flex is important for the holistic asset strategy, and rather than going to market, they want to do it themselves, we do it under a white label arrangement. We're the engine that delivers it, right? We design it, we build it, we fill it, we hit our commercial targets, we hit a rent target, and we get paid a management fee, right? Which is a trend that's happening, you've probably noticed over the years, because transparency and control is super valuable for an owner. Because if they understand, I wasn't recording the screen, sorry. I'll start recording now, but that means I have to rewrite the 1500 square meters. Whoop. I'll rewrite that now. Because what was I saying? Transparency, because it means if anyone outgrows the co-working space as a building owner, it's super valuable to know what their journey is so you can put them in a vacancy within their asset, right? Rather than a traditional co-working operator take it and move it into another site or give it to a leasing agent or broker and bank that commission. So I digress. The 1500 square meters is because I'm starting to see co-working hit many markets by storm because it was a response to hybrid work, COVID, major companies asking for flexibility. So it's becoming a little saturated in the market, which doesn't mean new ones can't pop up. But I think the days of 3,000 square meter, 4,000 square meter sites are limited. You might get occasional ones working because, they've got the right brand to really fill it. It's in the right building. However, whenever we look at these things, even though economies of scale really kick in at around the 2,000 square meters, so I'll put that in brackets, meaning your costs are covered and you're making margin. And I've done a video on the economies of scale and how that's explained if you want to go looking for it, where I show, I think, a 1,200, a 2,000, and a 3,000 square meter site and the costs. It looks good on a spreadsheet, but it's no point doing that if the building you're looking at is surrounded by 3 or 4 other operators that are only at 70% capacity themselves, right? You're going to have a hard time, even if you try and differentiate it. So what I'm doing a lot now, the last 2, we're about to open one in Canberra, Australia. We're about to open one in Auckland, New Zealand. They're both sub 1,1500 square meters in size, because it may not be making the biggest amount of margin, but it's an appetizingly sized space that makes good returns, and you can fit in enough stuff to also not just make it a very desk-heavy offering that has amenities for the tenant community and other people within the building and precinct. So 1,500 square meters. How many desks fit into that? Now, this is a preliminary feasibility video. So before we go into floor plans and do test fits and designers, I think a very safe square meterage ratio to use is 7, okay? Normally you could get, sometimes you see 4.5 to 6. 4.5 is a density that WeWork is famous for using in many markets, especially in Asia, where it turns into a bit of an ant farm. That's not what you really want to be doing. Sometimes 6 works. We've gotten away with 6 with many sites. The reason why 7 is safe is because before you actually pop the hood on a floor plan and see where the columns are situated, what the facade looks like, where the natural lighting is, all that kind of stuff, you realize that the areas that you can put desks start to diminish slightly. And what looks like, in theory, that you could apply a 6 ratio, 7 is a lot safer because you start losing that space. And if you can fit more in, then you can always go ahead. This video is going to be in square meterage. I'll do a square footage one in the near future, but the conversion's relatively easy. If you're watching this, just go with me on this, and then in the back end, just convert it to square foot, okay? Because it's market agnostic, the stuff that I'm talking about right now, mostly. So if we apply a 7 square meter ratio to the 1500, you get about 215 desks, okay? And the 7, that doesn't mean there's 7 square meters around each desk. The 7 is almost a bit of a formula after you've done feasibilities enough that it accommodates, your circulation space, the amenities, the concierge, even the toilets and that kind of stuff. Dead space where, like, if you open a door on the office, it doesn't hit something. It factors all of that in. So when you divide it by the total NLA, which in this case is 1,500 square meters, it gives you a pretty accurate rough estimation of how many desks you can fit in there. The desks in reality only have maybe 3 to 3.5 square meters around each desk. So when they're in the office or in the open plan environment, so keep that in mind. Okay, Tash, 215 desks, that's cool, but what does that actually mean? For the purpose of this video, we're going to go with 185 in private office, and we're going to go with about 30 in open plan. So that split is about 85%, 15%. And this is in a central business district environment, okay? If you start going out into the burbs and stuff like that, the ratio could change a bit more to like 60%, 40%, still in favor of the private office, because your rent expectation might be a bit lower in those suburban areas or outside of the central business district area. There might be high demand for just the open plan setting. Less of the larger companies are situated there. You get more people that just want to work within a co-working environment. However, always remember the private offices, they're sold 6 to 12 month licenses at a time. So if you're watching this as someone considering co-working, think about it this way. If you've got 215 desks, wouldn't you sleep a lot better at night as a business owner if 85% of them were, when they sell, they're sold for the next 12 months plus, right? You're not worried. They're not sold on a month-to-month basis, which is what the open plan desks are sold on. So you're not going to wake up every other month and be like, oh no, we've lost half our customers, right? I think a big reason also it's moved more into the private office kind of segment is when you think about your client demographic for flex space today versus years and years ago, it's moved away just from the mum and dad businesses, the tech startups and flip-flops and all that kind of stuff. It's now very heavily moving into enterprise and larger businesses and companies looking for satellite offices, wanting to decrease their footprint and embrace flexibility because of where the world is right now and employees wanting flexibility and experience. So private offices, right? So in this model, 1,500 square meters, we use the 7 ratio. We've got 215 desks. We've got 185 in private offices and 30 open plan. Cool, good start, okay? And I'll just note, the higher you go, so let's say you're in a situation where you actually want a gun for 2,000 square meters or 20,000 square feet, you probably could get away with a slightly lower ratio, 6.5, because the bigger the space, the more scale you've got, the more desks you can kind of fit in, because whereas the smaller you go, I would say would get even higher. So if this was like 1,000 square meter space, your desk density ratio should go from 7 to probably 8, if not higher. Because remember, that density accommodates for the communal areas, the amenity, the concierge. Those spaces to a certain degree will stay a specific size. You can't just keep shaving them away just because your total quantum of space gets lower. To garner a certain experience, they need to be a certain size, right? So that's part of the reason. But 7, I like 7 a lot. Now, in terms of what kind of revenue assumptions, how do you approach these private offices and open plan? They're going to be priced differently. So again, I'm going to throw some numbers at you because it's going to reflect the P&L that you see that we run through. The private office, let's say after doing some market due diligence, you think you can get away at $900 a desk. And the open plan, maybe 500, right? Open plan, you don't really need to apply any incentives. It is what it is. And that target customer that kind of comes in and out will pay that because they really are paying for the flexibility, that ad hoc month to month basis. But when you have the private office desks, don't just model for the 900 in this scenario because you've done your research. You're like, oh, that's pretty conservative. 900 is going to be like your marketing, your listed price, how you sell it on your website, on your platforms, when you cold call people, when you respond to leads. But you almost want to have year one and year two plus two prices ready for your modeling when you model it within your feasibility. And again, reach out in the link if you'd like me to build you a model and you'd like all of this kind of stuff, because it does get, we're going to cover the basics, but it does get a bit more detailed. And if you're considering setting this stuff up, it's better to get it right the first time. Okay. Year one, let's say you've got a 25% discount. And then year two plus, you might have a 15% discount allocated in your modeling. What does that mean? That basically means if you're catering for the scenario for your sales staff or yourself, if you're going to be running it in there, if you get a customer that says, great, I want 30 desks. I want to license it for 12 months, maybe 24 months. But where's my deal? Where's my deal, man? You know, you're not going to sell for 900 a desk. You might give them, 3 months off the 12 months if they buy that much space, which is the 25%. And then to retain them moving forward, you know, let's say they do the year and you want to retain them, it's going to be a bit tough to go from the 25% discounted price, which would be $675, back to 900 straight away. You might churn them. They might be like, oh, there's another co-working space that we're just going to hop over to because they're about to provide me with a discount. I think 15% is a good thing to model for. So that's 720. Because then when you renew them, you could be like, oh, okay, you know, eventually we need to get back to that 900. But from year two for another year, I can give you a 15% discount if you stay, right? The 900 is a good litmus test, is a good number for you to do your research to be like, that's what it's worth in the market. But in a co-working and a flex business, you're going to have to do deals. It's quite competitive. So model for the deal number, right? Model in this case for the 675 in year one and the 720 in year two. And the year one, the 25% discount, the 675 is more important because you're going to start at 20% occupancy, 20 to 30%, right? You want to do enough pre-sales and marketing that you open at 20%, so you're making enough money is coming through the door. You've already pre-sold it before you even open. That covers some of your costs, like your staff and everything like that. And then you want to ramp up to 85%, you know, across 12 months. You know, I've been modeling 15 months just in this market. But if it's a smaller site like 1,500 and below, I think 12 months is still achievable. Okay. So in that first year, if you're expecting to go from 20 to 85%, the 25% discount is going to help a lot to get that, isn't it? Right. Which is why you model that first year at that lower discounted rate. Because also the more full the site gets, there's an element of fear of missing out. There's a community, there's a buzz, there's a vibe. It's easier to fill and retain people. Okay. Now, so that's your desk density, and we'll look at how that looks like in the model soon enough, because I'll highlight the rows as I go through. Meeting room theory. Okay, this one depends on how you want to approach it. So let's start with how many meeting rooms you should apply to a 1,500 square meter space. I'm a big believer that no matter how big or small, you kind of need at least one of each type of meeting room. And what does that mean? Well, in this case, I want rub that up. I want one boardroom. So that's like 12 to 16p, depends on where you can fit it within the floor plan. I want one 6 to 8 person at least meeting room. I want 1 to 2 4 persons, you know, your 2 to 4Ps. And I reckon every space should have at least a podcast studio now. Because I just feel like, Exhibit A, I'm doing content right now. I think, especially for corporate clientele, content creation is key. Authenticity is key, especially in an AI-driven world. So there's going to be a lot of companies that are going to want to explore doing content and have marketing budget for it. And they don't have that kind of gear or stuff in their own space. So if you have it in yours, it'll probably be one of the best performing meeting rooms within, you know, your model or in your budget. Because when you think about it, Meeting rooms, normally you book an hour at a time and blah, 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 and they're per hour. But a podcast studio, you'd probably see, 3 to 5 hour bookings at a time, because it's content creation. It's not just an hour and done. You probably want at least 2 hours, maybe a buffer of another hour. Or if you're doing an episode, you might have multiple guests that day. I don't know. I just see them doing really well. And then if you can, one event space. These days I see around 30-person event spaces. That's the magic space. That's the magic size. 50-person, this is the Australian market. That could differ from a market basis. 50-person, you really need to figure out if there's a need for it in your building, meaning understand who are the tenants in the asset, speak to the building owner, ask if tenants have been asking for that kind of stuff, look in the surrounding area, see if there's no real event spaces, albeit there's a lot of hotels and stuff that compete in that space with their ballrooms. I think 30p is good. And there's a way to look into the design of these meeting rooms that if you're willing to spend upfront on the capital, modular walls allow some of these to be one and the same, especially the event space. If you don't want to give up that space for the event space could be the boardroom and another room kind of combining to open up into the event space with your communal area. And if it wasn't clear, these meeting rooms, there are these meeting rooms that I've kind of accommodated in this, that I've listed off. Maybe not the event space. That's a bit of a question mark when you kind of look at the test fits and stuff, when you work with a designer or you see the actual floor plan. They're also accommodated in that 7 square meter density, right? So that's why the 7's good, because it's like, oh, that's assuming you've got some of these meeting rooms baked into that as well. Meaning I can fit 215 desks and I can still fit in my boardroom, my 6 to 8p, my 2 4ps, and my podcast studio. Okay. Now, in terms of rates and stuff like that, the dollars, I won't go into that because it's going to be specific to your market. But what is important is the usage. So the desks you saw, you kind of ramp up to an 85% occupancy, 85% doable because they're desks, they're sold months, if not years at a time. Meeting rooms, even 25% is a rich assumption. And this is based off after you calculate how many hours are available per week or per year that you can sell between like 8 to 5 p.m., right? And 25% sounds low, but you got to remember, these are sold on a per hour basis. Very unreliable revenue. Meeting rooms actually make more money than offices and desks if you sell them 60% of the time per square meter. So in theory, again, if we had no sense of reality, if you wanted to make as much money as possible out of a small amount of space, you wouldn't even look at offices, you just fill it with meeting rooms because they make more money per square meter. However, risque business, right? Like meeting rooms are seasonal. Sometimes they get used like crazy, sometimes they don't. So your financial forecast is not reliable. Whereas when it's dominated by these private offices and desks, way more reliable, right? Because you can sell them years at a time. And the reason why 25% is also rich is a lot of the times you may, as a business owner, as a co-working operator, decide you don't really want to model too much for the meeting room and you go as low as 10% in terms of revenue because you want to package up that usage into your desks. So if you're a customer and you go and you buy a private office, you buy 10 of them for $900 a desk, you might expect to be like, hey, I want X amount of hours of meeting room usage for free because it's part of my package. Right? If you start looking at that and you don't want to worry about people paying for meeting rooms, that $900 might turn into $1,000, right? It depends on how you want to approach it. However, I feel like meeting rooms are a strong channel of revenue that should be optimized. I feel like co-working and flex in general as a market needs to do a bit of innovation in terms of where they make their money, not just rely on desk density. How do you capitalize on meeting rooms? Like, you hear a lot about cafes and hospitality, and I've done an old video on it. Cafes are not a way for you to make money as a flex or a co-working business. It's an experience adder. You're going to lose money on that cafe or it'll break even at best. But the only reason you should ever consider doing a cafe as a co-working business owner is it helps you justify how much you charge for desks and meeting rooms because it's there. It should not be modeled to make money at all. Food and beverage is one of the hardest industries you can work in. I've done many deals and I've worked in partnership with their core hotel group, modeled stuff with them, open stuff with them, and the margin is so small. The only way a cafe could ever consider making money is if it's on the ground floor and it's got a healthy amount of foot traffic coming off the street as well as servicing your co-working space. If it's up on a floor, hidden away somewhere, consider it just as a cost of doing business. So you can offer coffees and maybe some grab and go food to your members. So you can charge more for the desks, okay? So no cafes, right? Now, there's other revenue streams we can talk about. I'll jump into this now, this P&L. So this is a mock how I like to run it, P&L, where you look at the revenue, the costs, the profit, blah, blah, blah. So we kind of talked about, you'll see year one and year two. Year one's less because you're ramping up. So the average occupancy of that year is 71% because you're starting at 20, going to 85. I think I've assumed 15 months to ramp up. But you can kind of see you got I'll highlight in green. You got your private offices. Why isn't this highlighting? Sorry, guys. Give me a sec. Sorry about that, team. I'm going to have to use the pen because I couldn't get the highlighter to work. But if we look at revenue to begin with, you'll see that it's broken into private office desks, flex desks, meeting rooms, and ancillary revenue. You can kind of see that, and we talked about the desks and the meeting space. The miscellaneous ancillary revenue is more, hey, are you going to look at a mail delivery system? Are you going to look at concierge services? Are you going to offer extra things in the meeting rooms? All that laundry list of stuff. And again, it's not a lot of money, but everything helps, especially when you've got a small NLA. So food for thought to think about that. And the flex desks, you'll notice, it's not a large amount of revenue when compared to the private offices because you don't have a lot. But what it does offer is a bit of diversity in the product offering. And even when you start looking at test fits in the floor plan, it could be strategically positioned and used to help the floor plan breathe, just so it looks a lot better. So it's not just offices and offices. Now, and we'll look at year two. So cast your eyes over to this year because year one is scaling up, year two will start. Let's look at the costs though, because I think this is interesting. I've actually got costs in year zero because think about it. Don't just think about, it's going to kick off from year one when I open it. These costs are a combination of, hey, I'm going to have to hire staff at least a month or two before this thing opens. So who's going to pay for that? And this is before you're even making any money, right? Because you need to train them. They're going to help pre-sell the space. So it might be a month, might be two, and it might just be one staff or two staff. So that's the major crux of this cost. But then also we've got, you might hear some construction going outside. Sorry, I'm in my garage right now shooting this video. You've also got your internet and your network and your infrastructure, all that kind of stuff setting up, right? And the pre-marketing is the big one, which kind of makes up that 160. I'm not saying that this should cost you this much, but just for this case it is. Like, what are you going to do for branding? How are you going to set up the website? Your pre-marketing, that's all going to cost something. So it might not be 160 grand, could be 50. I know some operators do it quite lean, but they're leaning on some of their neighboring sites because they're a portfolio-wide business to bring that lower. But just think about what it's going to cost you, right? So if we look at the different costs, you got your property costs, which is your repair and maintenance. It's your cleaning, it's utilities, it's your pest control, right? So you'll notice that it's around 101K for a 1,500 square meter site. I can break this down in more detail if you reach out, but for now, we're just going to talk about the high level costs. You've got your operational costs, which is like your flex operating costs. This is your internet, your network, your activations, what kind of flex software are you using to facilitate the bookings and everything. That's about 184K. And then the chunk of your cost, your overheads, that's your on-site staff. So, and your legal, your HR, your PR and marketing, even like, are you going to have biophilia in the space like plants and you're going to maintain them with someone to water them and things? For this particular one, we had two full-timers for this mock example. We had two full-time staff, a center manager and a hybrid community manager, flex concierge. You can't really get away with three full-time staff for a 1,500 square meter site. It's only like a 2,000 plus, do three staff members make sense. So I've got a rule where two is almost like the minimum amount of people you need to run a traditional style co-working space with lots of desks and all that kind of stuff. Because anything lower than two and you just have one, even if it makes sense on paper and you leverage AI to automate a lot of things, unless they're integrated into the property asset management team in the building and there's other people on site they can work with, we're all humans at the end of the day. they're going to turn over. They're going to get bored. They're going to get lonely. They're going to quit and go somewhere else. So think about that. It's a common overlooked thing. And if your staff keeps turning over, then your retention for your space is going to be horrible because your customers are going to be like, oh, where's the friendly face? Just it's not good. For this particular one, you got outgoings here. So outgoings in an Australian market context is just your building costs. It's normally included in the rent. So the landlord might be like, oh, it's going to be $100 a square meter because we're going to clean the common areas. We're going to do all that kind of stuff. That's normally included in this model because it should be a cost. Base rent hurdle. This is now going into the territory of if you're an operator doing a deal with a landlord under a management style agreement, a partnership, you may not just pay, well, you won't pay just a traditional rent, like, oh, what's that cost? $800 a square meter, cool. You might agree to a hurdle though, whether it's half or a certain percentage of it. So as a landlord, they feel like, okay, well, we're going to cover that hurdle out of the revenue that the flex of the co-working space makes before we start talking about profit share or anything like that. It gives them a bit of comfort because they're taking a lot of the risk under a partnership style agreement because they pay for the capex, right? So for this particular space, I think we estimated costs like 3 million Aussie bucks to make, right? The landlord will front that. And according to this projection, which is conservative at 85%, their ROI, their return on investment is year 4, okay? Which is okay if they're considering this is a long-term 10-year thing, even though this is a 5-year forecast. And then the operator fee, what I like to see is higher of a certain fee and a percentage of revenue. So in this case, it's either higher of 60K or 6% flex revenue. So you'll kind of see in year 2, if the operator is doing a good job and hit 85%, they should be seeing about 120K in fees in year 2 for this small site. And then you got your profit share, which is 95% to the landlord, 5% to the operator, negotiable, which is another 18K to the operator. So now you're looking at, 140K for the year. And that's if it's at 85%. If you hit 100% or you're at 90 or you realize the meeting rooms are doing better or you figure out other ways to generate revenue, like, I feel like sponsorship revenue is a big one. If you suddenly create a brand and you've got a community of really engaged people, an authentic audience, there might be some brands out there that want to get in your newsletter that will pay you a sponsorship fee for it, that kind of stuff. You never know, right? Or you figure out how to optimize your ancillary revenue, that could be more because as an operator, you're getting a percent of it. This is under a management style agreement, right? You might just be looking to do it under a straight lease, which means more margin for you because this will look very different. Or as an owner, you're thinking about doing it yourself. I just implore thinking about getting an operator in the mix if you're looking at traditional co-working because think about it this way. As a building owner, you maybe are used to having 10 customers, 10 big tenants in your asset. Suddenly, even in this scenario where you've got 200 plus desks, that's probably, you're looking at, 30 customers, like on top of the 10 that you've got. Do you really want to be worrying about, renewing them, making sure they stay at the right price, blah, blah, blah. And it's also how you present the brand. It could be something that you could use to elevate your building, right? So I think I'll stop there. I always like to have this here, which is the plus X dollars. So whenever I present this stuff to owners, I'm like, hey, I know it's not measurable right now, but I'm going to put plus X dollars because there's a value in retaining your tenants in the building. So forget the flex customers. By having this, if your tenant needs flex and it's there and they're happy or there's amenities and there's an experience in the space contributing to your building and it's helping you reduce downtime and attract tenants and retain them, there's definitely value there. So what is that value to you? We can do some financial jujitsu and figure it out by reducing downtime by a certain percentage in your asset or completely, but there's more value to the owner than that. So even if they're not ready to attach a dollar to it, I like showing them that. So hopefully this was helpful. I'll stop there. And if you like this style of content, please let me know. This is a very basic and generic annual summary. Each of these cost and revenue line items are broken down into much further detail. And if you're interested in exploring that for a particular building or your own or learning more, please reach out in the link via the description. So good luck. You got this, and I'll speak to you again soon.